And a great example of that was, of course, the recent CBA run, where CBA went up and up. Every superannuation fund manager in the country, in fact, the head of investments, the Australian Super, went on the record in the AFR saying, we do not want to own CBA. It is completely overvalued. It's the most overvalued bank in the world, but we hold a quote unquote market weighting of CBA. In other words, I'm buying it because everyone else is buying it at the same proportion as they're buying it because we can't risk being left behind.
Right.
And then, of course, what happened is suddenly the market turned. CBA went down 10% in a week. And now we've just blown up a whole bunch of investors' capital. But we didn't do it unethically or illegally, so we get a pat on the back. We did it the right way.
So superannuation in Australia has now reached $3 trillion. So it's something that every Australian, or just about every Australian, is concerned or at least thinking about or has something to do with it. What's happening?
It's a great question, Kerry. Look, I think firstly, just to put this in context, because it's one of those sort of classic questions, rather than thinking in terms of billions or trillions, it's sometimes easier thinking in terms of real world value. So as an example, the easiest way to think about it is Australia's superannuation industry is now roughly double the size of the Australian economy. Wow. So if you think about what that means for our country, effectively we have had the Hawke and Keating, but particularly Paul Keating reforms have developed one of the deepest and broadest pools of retirement investment savings in the world. And that's a great thing for the country because, of course, the original idea behind superannuation was to reduce the cost on the public purse of people reaching retirement and living longer and getting into pension phase. Unfortunately, the challenge whenever you get a very large pool of money is that the sharks will start to circle.
Okay.
And in this case, I think we have two sets of very large sharks that are circling the market, or three sets actually. The first, of course, is the government, because never before in the history of man has a government seen a large pool of money and not decided they want to tax it. So it's not surprising that suddenly Jim Chalmers and the Labor government is looking at a very large pool of money, and a pool of money that is growing at a rapid click because, of course, every working Australian contributes to superannuation, and on top of that, that superannuation money earns a return. So you've got a double compounding effect going on. Yeah. And it's not surprising, therefore, that a government needing budget repair, and we do, that's, I think, not a political statement. You know, Australia in general is running budget deficits, and we can't do that forever. Needs to raise the tax take in some way. Yeah. And there is a very large pool of money that's sitting there sort of screaming, pick me, pick me, pick me. Particularly valuably from probably a political point of view, because the vast majority of people whose money is in superannuation don't really think about it. You know, if you're 25 or 30 and you're working and you think you're not going to access it till you're 55 or 65, this is not a high political stakes game for you. You know, your Bowser price, your stamp duty on your home, your income tax, those are, you know, high profile.
They're hurting right now.
Exactly. Yeah. Your superannuation money that you may or may not get, but you probably look at your balance once every few years if you're lucky, is probably not something that is going to cause a lot of political angst. Now, of course, the Jeff Wilsons and others of the world that are out there in that market, it's going to cause angst for them, and they're out there. But that's a very small portion of the Australian population. Yep. So that makes it an easy target. The second pool of sharks, of course, that are going to be circling and are circling are, of course, bad actors. And you've seen that recently with the Shield Master Trust and First Guardian scandals that are breaking. And it's no surprise that we're going to get more and more scandals in superannuation, sadly, because when there's a large pool of money that people don't think about every day, that's sort of 101 for the scam artists and bad actors, right? You know, here's a very large amount of money that I can go after. People aren't going to look at it every day. They won't really care until, you know, in the future. So it creates, I'm not saying this is right, of course, I'm very anti it, but it creates an incentive for those kind of actors to chase access to that money. And so the beginnings of scandals have started to occur. I think they're just going to roll on greater and greater. And that's the case with any pot of money that is not looked at. You know, the old treasury left in the back of the king's palace was always going to attract attempted burglars. The same thing with superannuation, left in your back pocket and not looked at.
Yeah.
And then the third group of sharks that are circling the market at the moment, and ironic that I'm going to use the word sharks here, is the regulators. And amusingly, this is a case of great intentions, poor outcomes. That lovely old line of the law of unintended consequences. Because really what's happened is, as regulators have realised this pot of money is getting bigger and bigger, and it represents more and more of Australia's life savings, they are doing their best to do the thing that regulators are entrusted with doing, which is protecting the lowest common denominator. And unfortunately, a lot of the legislation that has been pushed and a lot of the regulation that has been done, I believe, by ASIC and APRA is actually counterproductive. And I don't mean counterproductive for returns. I mean counterproductive as in it is actually going to hurt the very people that it is attempting to protect. And a great example of that is the My Super legislation that was put in place about 10, 15 years ago, which in theory was designed to remove poor performance from superannuation by, ranking all funds every year, and then the bottom quartile get a please explain, and if you're in the bottom quartile twice, you get cut. And the idea of that was to bring fees down and performance up. And of course, it's done the exact opposite when you look at the data. Fees have gone down, sure, but in the process of fees going down, so too has any effort or thought. And therefore, as effort and thought goes down, so too have returns. So the net result for Australian superannuation investors is they're now getting more anemic returns than they got 10 years ago, in the attempt to improve their returns. And of course, my thesis, amusingly, back at university, my honours thesis was on exactly this. So at the time, there was no My Super legislation. It was quite funny because we wrote the paper, my supervisor and I, and it did very well. And then we tried to get it published, and we ended up getting it published in quite a good journal. But the challenge in getting it published at the time was journal articles and journal reviewers saying, well, this is really interesting that you've talked about where incentives in a pot of money like superannuation could go. But no one's going to be dumb enough to legislate like that. So it's a really interesting theoretical study, but
it'll never happen.
Absolutely. And, amusingly, too many years on now, it's very topical. And it might be worth just unpicking that a little bit. So what we looked at back in 2009 when we did this, what we looked at was this question of what we called inter-firm competition. But really what that means is it means that in theory, under economic rationality,
right,
all that a fund manager should be doing is trying to maximize the risk-adjusted returns. Make more money for my clients.
Yep.
Simple as that. And that should be done on what's called an absolute return basis. In other words, as you would know, have more money in the pot today than last week.
Yep.
And the amount of the difference is what matters. And who cares what's happening in the rest of the world? All that matters is you're growing your pot as well as you possibly can. Of course, the world doesn't work that way. And we know as humans that we don't always use absolute returns. We use relative returns. We compare ourselves to our neighbours. So the question we tend to ask is not, did I do well? It's, did I do better than Kerry?
Yeah.
Or did I do better than Peter? Which, of course, is a silly question to ask because who knows how they got their returns? Did they take risks? Did they make other decisions? Did they get lucky? But we do it. We're human.
It's just human nature.
Exactly.
Yeah.
And it gets particularly pronounced and easy to do in the market where things are being marked to market very regularly because, when you buy a house, you might only know if it was a good investment 10 years later when you sell it. Enjoy living in it, but, for 10 years, you won't really know if there's been capital growth. But, of course, in the share market and the bond market and the crypto market and all of these asset markets, you get to look by the hour, let alone by the day or by the week to see, is this a good decision? So what happened was about 15 years ago, the Australian government decided that using absolute returns, or Australian regulators decided that using absolute returns was a poor benchmark because the problem with superannuation was the idea was to compound for sort of 40, 50 years. And if you're using absolute returns and it's going to take you 40 years to determine who's the best fund, well, that's too long in advance for someone who's got their money today and deciding where to put it to use as a metric. It's not easy to say, well, I'm going to put it into Fund A versus Fund B because their 40-year return is better when no one has a 40-year return.
Yeah.
And 40 years is a very long time away. So the Australian government decided that from looking at it, there were two main things, and the regulators decided there were two main things that seemed to be impacting returns, net returns to investors. The first was fees, and this is the same passive-active argument we've had before. Bring fees down, then obviously the same gross return ends up as a higher net return if there's less fees taken out. So the first thing they did was encourage a consolidation of funds and a reduction in fees. Make the funds bigger so that the admin fee is smaller per person, an economy of scale. Bring fees down, and therefore, as you bring fees down, the net return to investors should be better. That has all potential flaws with it, but we can talk about that another time. The second thing they did, though, is they said, well, hang on a minute. 40 years of absolute return data or 10 years, whatever, it's too hard for someone to make a decision. So what we're going to do is we're going to create a very simple ranking. Sounds like with the petrol thing we did, right? Remember, we're going to rank petrol stations. A really simple ranking to say which are the best performing funds and the worst performing funds. The worst performing funds, we're going to wrap them over the knuckles and tell them, get your act in gear or we'll get rid of you. And the best performing funds will naturally say, well done, and go on.
Yep.
Sounds really logical. The problem with that, of course, is you then have to pick a horizon over which you're judging, are they a good or bad fund? And so we suddenly went from having an investment horizon of superannuation in this country, which was in theory 30, 40, 50 years, and turned the investment horizon into 12 months, because the easiest way to measure things is to look at annual performance, right? I mean, I'm a regulator. I don't want to make my life hard. Funds come and go. They start. It's really hard to work out a 10-year return when I'm comparing your 15-year fund with a 5-year fund. So let's pick one that works for everyone, 12 months. Of course, and I can see you nodding here, this then created a couple of perverse outcomes. The first perverse outcome is the fund managers looked at this and went, I can't charge a fee anymore. I've got to bring my fees down, and I've got to make sure that I'm not in the bottom quartile. So what's the best thing I can do? Well, it's copy each other's homework. Rather than coming up with an idea that may or may not be right in a 12-month period, I've got this great high conviction idea, but it might take 3 years to play out. I can't take that risk. Plus, it costs me money. I've got to employ people to come up with this idea and do the research. What I'm going to do is I'm going to start holding indexes. I'll hold a bond index. I'll hold a crypto index. I'll hold an ASX index. I'll hold an MSCI World Index. I'll hold the S&P 500. And then that way, yes, I won't ever end up in the top quartile, but I can never be in the bottom quartile. Exactly. And given that being in the bottom quartile is an existential risk for my fund, the regulator might shut me down. My upside is limited. My downside is unlimited. I'll just avoid the downside. And the big advantage of doing that too, number one, I can't be shut down now. Yay. But number two, I can keep costs really low. Because if I don't have to employ any brains to make this decision, and brains are expensive, then I can make it really low cost. I can charge you 10 basis points less than I used to charge you. And the regulators pat me on the back because they say my cost to serve has come down. And yeah, I'm on the average. Exactly right. And long-term averages is okay. So that's exactly what we've had. The second problem we have with that, though, which is a more fundamental problem, is on the margins, that's probably okay for society. You can say it's bad funds management, and unfortunately, the person who's ended up getting an average return may be unhappy with that. But for society, on the margins, there's no damage. If one fund manager does that, big deal. It doesn't affect the markets. It doesn't affect anyone beyond their investors. The problem is when you aggregate that. So if you take a scenario, and let's take an extreme here, that says every superannuation fund in the country wants to keep costs down and track the middle because they can't take any risk, then you start to reach a scenario where more and more money is going to be thrown into assets, not on the basis of are those assets good, bad, or indifferent, but purely on the basis because everyone else is investing in them. Now we're starting to see where the problem becomes, right? Because the very definition of how you create bubbles and crashes is, of course, people throwing money into assets based on other people throwing money into those assets, or alternatively, in the case of a crash, taking money out of an asset because someone else is taking out, the old run on a bank, not because the asset is mispriced, but purely because I'm seeing the other lemmings jump off the cliff and I need to jump with them. And unfortunately, that was what we proved in the lab in my thesis more than 15 years ago now. It's unfortunately, I think, what we're seeing happen in the Australian markets today. And a great example of that was, of course, the recent CBA run, where CBA went up and up. Every superannuation fund manager in the country, in fact, the head of investments at Australian Super went on the record in the AFR saying, we do not want to own CBA. It is completely overvalued. It's the most overvalued bank in the world, but we hold a quote unquote market weighting of CBA. In other words, I'm buying it because everyone else is buying it at the same proportion as they're buying it because we can't risk being left behind.
Right.
And then, of course, what happened is suddenly the market turned. CBA went down 10% in a week. And now we've just blown up a whole bunch of investors' capital. But we didn't do it unethically or illegally, so we get a pat on the back. We did it the right way. We lost money with a smile rather than we lost money dodgily. And I think that's the challenge here, right, is that if we have more and more capital flowing into assets on the basis purely of the price of that asset, not its underlying value. And if you're doing low cost market matching, you can't be looking at the underlying value. It's just not in your mandate. You don't have the cost to do so. then are we creating a scenario where our market starts to break and not do the one thing markets are meant to do?
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
We invented the concepts of markets, and the reason we like them in economics is the idea is that the market should aggregate all the information from the know somethings, good and bad, and do what we call price discovery. Find out the underlying value of the asset so that capital can be allocated to the most productive places. So, a really good business that's growing and has opportunity to use capital will get capital. A business that's not being well run will be punished and capital will be withdrawn. But if no one is asking, is this a well-run business?
Yeah.
And instead is asking, is price up or down, or what's the market weight? Then the market fails to perform its first primary function of being a price discoverer and an allocator of capital. And I think I'm going to go very controversial here because there's about to be a productivity summit. I think the reason that we have a productivity problem in this country can be traced entirely back to our superannuation reforms, because there is zero incentive now for a well-designed business to go out and try and raise capital in public markets on the basis of I'm undervalued, I have this opportunity, because the vast amount of capital won't touch them. And on the other hand, for a business that's poorly run, what's the incentive to fix how you're running? All there's an incentive to do is maintain my index weighting or increase it, and I will see my share price rise because 12% of everyone's earnings are flowing into these funds that must own me. And if there's more in the buy than the sell, price can only go in one direction.
Wow, that's a lot of information, but that is really concerning. So basically what we're saying is if the superannuation funds are following index funds, which they are, because we've already said that that's the cheapest way to run, then,
and what the regulator encourages.
Then they have to simply follow the percentage weightings for their investments as to what the index does.
Which becomes self-fulfilling.
Which means that if you've got more money going in, then your price is going to lift. And it's not, as you suggested, it's not necessarily because then the company is worth that amount. It's simply because they have to follow that mandate.
Absolutely. And this is going to look really good on paper for a long time. So superannuation funds are going to show really good performance, maybe not what we would call really good performance, but relative to perhaps other markets' performance, low double digits or high single digit annual returns.
Like we said, they only have to be better than the person
exactly
next to them.
Right. So, they'll show 8s, 9s, 10s, which, for most large pools of capital in the world is a pretty good return. We might call it poor, but, comparing them to their peers in the global marketplace, they're doing quite well. Yeah. They'll show those returns for a very long time because as the amount of capital that flows in is always larger than the amount that goes out, that fuel for that bubble keeps being self-sustaining. The problem is at some point, because we have a demographic challenge in Australia, we have a declining working population, we're having to import to make up the gap. Eventually that tide is going to turn. And the amount of money coming out of superannuation redemptions, in other words, pensions redemptions, is going to exceed the amount of money going in. That'll be exacerbated if there's tax changes. But I mean, at the minimum, that has to happen at some point. And when that happens, you're going to have a withdrawal capital, so you'll get a much bigger crash. Because in the same reason as they're buying a business, even though they don't think it's good just because the price is up, if the price drops and they have to sell, well, they have to sell because the price has dropped. So it becomes a self-fulfilling spiral on the way down. And why this, I think, becomes really important for society is simply the people who are going to be hurt most in those scenarios are, of course, the most vulnerable. Because the most vulnerable and poor person who doesn't have the opportunity to run their money themselves or be a little more selective in what they choose is most likely to be the one in a MySuper low-cost index tracking product They are therefore most likely to be the one whose hard-earned proportion of their wealth is put into bubbles at the top and withdrawn from the crash at the bottom. And they're the ones who the extra dollar will mean the most to. You know, if you're super wealthy and it turns out that your investment performance only compounded at 7 instead of 10, well, that's unfortunate, but it probably doesn't change your lifestyle.
You're still sober.
If you're in the bottom quartile of income earners, the difference between those extra couple of percent is materially different to your lifetime standard of living. And so ironically, coming back to my point at the beginning, I think that the third shark that has circled is the regulators, and what they've actually done is they've created a system whereby superannuation is now designed to help the wealthy get wealthy and ensure the poor stay poor by putting their assets into the wrong things at the wrong time. But, you know, that's me being a little controversial.
And that kind of sounds like it's the opposite to what superannuation was actually set up for.
Yeah, well, if it was originally designed to enable people to have a nest egg such that they weren't required to rely upon government pensions when they retired, well, putting the poorest people's money into the riskiest assets and the wealthiest people's money into assets that they get to pick with a tax break seems the exact inverse of what it was intended to do. But that's, you know, government legislation 101, right? We set out with a great intention, the world moves on, people try and work out ways to game the system, and we end up in a problem. Now, of course, what can we do about that? I think the government is going to make a huge amount of changes to superannuation that will attempt to solve, in their eyes, the problem, which is the wealthy getting wealthier, and will do nothing to help poor people who are getting poorer. But again, the one has a nice big pot of money that I can tax. The other one is a lost opportunity cost that I don't see until the day they come knocking on the public purse. The 75-year-old today who looks like they've got a very big tax break is an easy target for a government. The fact that they played by the rules and did the right thing, who cares? They're an easy target for the government. I find that morally abhorrent, but that's not the point. I can understand from the government's point of view, big pot of money worth taxing. I want it. You know, mine, give. It's like my 2-year-old. Gimme, mine, my toy. The 25-year-old whose superannuation is not going to be worth anywhere near what it should be is not a problem for the current government. That's a problem for the government in 50 years' time or 40 years' time. So in typical fashion, that can will be kicked down the road. So we're going to address, I think, one side of the equation, which is an outcome, and not address the cause. You know, we'll deal with one of the symptoms, but not the cause, and in the end end up with a very large problem for those who are at the bottom sort of half of the distribution. Now, amusingly, though, why do I say this with an amusing comment? Because that's pretty bleak. Because it's actually going to be the best time to be wealthy and an investor. Because if, again, coming back to that podcast we did on active versus passive investing, if the majority of superannuation money, which is the biggest pool of money in this country and growing at a rapid clip, to put it in context again, it's roughly 4 times the size of money in other managed funds. So it really is the largest weight of capital. If that's playing dumb games, buying high, selling low, then again, if you are able to manage your own money, that's like going to a poker table and playing a round of 8 with 7 drunk people. You know, you could lose, you could still be given bad cards or luck could go against you, but geez, you've got to really mess it up.
Yeah. Yeah. And when you're doing the underlying things that we do at Teaminvest, understanding the companies, being prepared, all of that sort of stuff, then yeah.
Absolutely. And I think it's why our Teaminvest members are finding that returns are accelerating at the moment. You know, we talk around the country, but a lot of Teaminvest members tell me that they are now getting returns per annum. I'm always happy with their returns, but returns per annum now that are materially higher than they've ever got before. And they don't understand why, because the world is not a safer place than it was. You know, if the argument is my returns are better than 10 years ago, one logical answer could be, well, the world is better than it was 10 years ago. You know, everything's growing faster, it's safer, but it's not. We have a productivity problem. World GDP is declining. We've had a big pandemic. We've had all sorts of other problems. We've got wars all going around the world. We've got the rise of nationalism in the far right. And yet returns are better. That's an illogical outcome. But what is logical is to think of it on the basis of, if you're the only person doing work, or you're the only person, maybe a good analogy is if you're the only person studying for an exam, and now you're going to get ranked on your relative mark, your pass looks a lot better than it did when everyone else studied. You know, your pass might now be in the top few percent rather than around average. And I think that's what's happening. Most people in the market aren't doing any form of study anymore. Therefore, a little bit of study gives you a big edge. And the return that used to give you maybe 15%, you know, maybe 20% for the year because you bought a really good asset when the market got it wrong. You're now getting the opportunity to do that, but not make 15 or 20%, but make 50 or 100% on the same asset, because the market isn't just getting it wrong. The market is convincing itself it's wrong by feeding back into itself. And, there were 3 examples in the last year where we saw that happen, really rapidly, where markets dropped for no reason other than the share price was declining. So more people sold out. They fell out of an index. More people sold out further. And well within 12 months from then, the market had rebounded on that asset by, well north of 70%. And 3 companies that were very stable, right? So the 3 I'm thinking of course, for our members was JB Hi-Fi, which is hardly a company with a large amount of instability. It dropped all the way down to a PE of, I think it got into high 8s, but sub 9. And then went back up to a PE of 25. So effectively tripled your money on nothing, other than just it was out of favor. Super funds and others had to sell because price was going down. So they sold more. So price went down further. Eventually that movement shifted and it sold itself up. ResMed, where again, similar thing happened. And Johns Lyng, which went from at a peak, stupidly, I think, where markets got exuberant, all the super fund money was pulling in, it had moved itself all the way into the ASX 200 of $9 a share. Then started to turn, all the passive money sold out. It dropped out of the ASX 200, so more passive money had to sell out because now it wasn't in the index. Dropped all the way down to almost out of the 300 and a price of $1.90. And now, surprise, surprise, has had a takeover offer 2.5 months later at $4 a share.
Yeah.
So again, a doubling of your money, not by doing anything you wouldn't have done before as a fundamental investor or someone looking at the actual asset, but just because if everyone on the other side of the equation is running with the herd rather than actually looking at the asset, well, the edge is significantly greater than it's ever been.
And I think that's the key takeaway here, isn't it? We can't change the legislation. We can't change, well, not quickly, not tomorrow. We can't change a lot of these fundamental things that are in place. But what we can do is we can get smart about it.
Yeah.
And we can look at how our investments are invested and, take some initiative.
Absolutely. And I think that's the thing that any listener should do. Firstly, have a look if you have a superannuation account and you're not managing it yourself, which obviously is a different question. But if someone else is managing it, are you in the low fee index tracking product? And are you comfortable with that? You may be, but you should look into that, because if you believe in what I've just said being the case, then maybe being in the low fee product that all does passive investing rather active is perhaps much riskier than you otherwise would have thought. And then the second thing is, if you are actively managing your money, whether that's superannuation or other monies that you're managing, is try and see if you can find opportunities to take advantage of this material market mispricing. Because as you said, I can't change the government's views, but at least I can get wealthier. And then that way, when they tax me, there's something to tax.
Absolutely. And look, that's I think a really good takeaway there. If this is something that has resonated with you and it's something that you hadn't heard of, in regards to superannuation, I think you've uncovered a lot here and you've given us a lot to think about. But if this is something that resonated with you and you want to know a little bit more about Teaminvest and how we manage wealth, we also have funds that manage wealth the same as what we do. They follow the same principles as what we do with Teaminvest. Please reach out to us through teaminvest.com.au or subscribe to this podcast or even to our newsletters to just find out more about how we think and how we invest and the philosophy that we follow. But also, if this is something that you think someone else in your circle of influence would resonate with them, please share this podcast. Andrew, is there anything else that you would like to leave our listeners with?
No, I think it's just always be informed, right? But we all have access to 3 things that compound: our wealth, they can compound up or down with good decisions; our culture, that compounds up or down depending on who we surround ourselves with; and our knowledge. And the biggest advantage, of course, is that the knowledge only compounds in one direction. The other 2 can shrink, but when we learn, whether we learn from our mistake or from a good decision, it's still more compounding up. So whether you agree with me or not, that or my theses or not, that's up to you. But it always will benefit you to have more knowledge and be better informed. So seek it out.
Absolutely. Look, thank you for joining us today. Appreciate your time.
Thanks for having me.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.